If you are less than 30 years old, you've lived more than half of those years without much concern about earning, spending, and saving money. But as we increasingly realize, many of our problems and opportunities are related to money. Managing money makes it easier to achieve your personal goals. You can get the most or the best if you know how, and save more to solve future problems. What do they say makes the world go around? Yes. You would like to have a comfortable and secure standard of living with the income you have and expect to have. And you're more likely to do so if you know more about how to buy personal goods, cars, real estate, and insurance, how to borrow wisely, and how to save and invest safely and with good returns. This series of 16 programs for your TRS-80 will help you learn some of these things. What are some of the things you ought to know about money? Right. Unfortunately, many of the things we've learned about money are no longer quite true due to inflation. Inflation means that prices and interest rates on loans increase so that a dollar is worth less. The ways we may buy a home or borrow or save money are now different from those in the past. The selected group of goods and services that make up the government's Consumer Price Index cost $100 in 1967. Now it costs about $300. This change has hurt most of us. What is the name of this increase? Yes. Of course, most of us have partially offset higher prices by increased income, but mostly we've had to find ways to buy less of the expensive goods like energy. If we use our judgment to buy less of the expensive goods and services, and to buy substitutes whose costs haven't risen as much, our own inflation rate isn't as great as that for the Consumer Price Index. What does this careful buying do for us? Yes. The causes of inflation are complex and worldwide. We might say that inflation results from our desire for wealth increasing more rapidly than our production of wealth. Consumers, businesses, and governments all contribute to inflation. The rate of inflation will probably be lowered, but never completely eliminated. Homeowners with mortgages at low interest rates may feel they're benefiting from inflation. In fact, they aren't being hurt as much as more recent homebuyers who must pay more for homes and pay higher interest rates on mortgages. During inflation, who is hurt the most? Right. Income is money received for labor or use of capital. Wealth is the value of the things you own, like your money, stocks, autos, and real estate. While we can't invest in anything that's valuable, the word investment is often intended to mean securities like stocks and bonds. Tangible property, meaning touchable, includes things you usually wear out, like a car, which decrease in value, and also things you keep longer, like a house or jewelry. During inflation, these things will increase in dollar value, even though you use them, which are usually called investments. Yes. As a consumer, you must have money for your needs and wishes. Besides the sale of your investments and property, what source of money do you need? Yes. Income from investments and employment provide for most of our needs. Beyond our needs, we save and spend the rest of our income for things which give us status or pleasure. We should carefully consider our spending so that it gives us the most of what we value highest. Besides consumers, business and government are key sectors of our economy which receive and pay out money for their needs too. Government, of course, can just take the money it needs to operate. But sometimes voters refuse to pay taxes, as Californians lowered high property taxes when they voted in Proposition 13. By what means does the government get its money? Yes. Government is essential for protection and public services. It maintains standards for products and securities. For your personal financial health, be aware of the government actions which both constrain and protect us. Some are explained in this series of programs. Business, the second sector of the economy, produces most of the goods and services which consumers buy, and it pays taxes. Airlines, banks, insurance, and real estate companies are businesses, as well as manufacturers of cars, appliances, and clothing. Businesses use investments and borrowings to produce goods and services for a profit. You wouldn't invest in a business that didn't seek profits. Some are efficient and successful, some are not. The third sector in the economy is the consumer, the families and individuals who use part of their income to buy goods and services. This study of personal finance considers individuals as consumers and investors. It also explains the factors that can make buying, using, and investing effective or wasteful. Economically speaking, what do families do? Right. Every family and individual has different needs and values, although some needs are common to all of us. Food, a home, clothes, transportation, and health care. Even for these, our spending varies greatly. This program considers individuals as what? Yes. Beyond our basic needs, we spend for other satisfactions. The amount you can spend depends on your earnings, and this in turn depends both on you and the outside economy. The local and national economy, as you know by now, may be great, moderate, or lousy, and you can't control it by yourself. If it's good, you may call it prosperity or growth. If it's rather bad, it's a recession. If it's as terrible as it was during the 1930s, what would you call it? Yes. The level of the economy varies, and anything that varies can be said to have a cycle, even though its variations aren't absolutely regular and predictable. The phases of the business or economic cycle are expansion, recession or depression, recovery, and then expansion again. Your income almost surely will be affected by this cycle. Your income will, of course, also be affected by your own ability, effort, and luck. Less experienced, less educated, or less ambitious persons usually earn less. What sort of person usually earns more? Of course. The more experienced workers earn more in part because of seniority and custom, but maturity, experience, and training make most of the difference. Someone with more education generally earns more. If you have a grade school education, you'll probably earn $500,000 $1980 in your lifetime. High school, $750,000. A college degree, $1 million. But higher education does not guarantee a higher income, and many high-income individuals have limited education. Doctors, lawyers, engineers, and teachers need university degrees, whereas most welders do not have degrees. A doctor may make $80,000 a year, a lawyer $50,000, and an engineer $30,000 or $40,000. But a teacher usually makes less than $20,000, while a welder earns about $25,000. Does more education usually mean more income? Yes. You can calculate whether a college education is worth the cost. Since not all occupations requiring college degrees pay the same salaries, you need to find out the average salary of the occupations that interest you, both those which require a degree and those which do not. Also, you need to take into account the cost of college. If you invested the cost of college, say $20,000, at 6% interest above inflation, you would have a considerable amount at the end of 36 years. To calculate investment return from compound interest, divide the interest rate into 72, which will give the number of years required for the investment to double in value. 6% into 72 equals 12 years to double. In 24 years, it will double again, and in 36 years, it will double a third time, yielding 8 times the original investment. If $20,000 were invested at 6% interest above inflation for 36 years, what would it be worth in constant dollars?
Oh, that's crap.
Right. So for college to be financially beneficial, a job that requires 4 years of college must pay $160,000 more in 32 years than a job that doesn't require college pays in 36 years. Of course, there are many non-financial reasons for choosing a career or going to college, but do not assume a degree will always yield more income. There are obvious reasons for saving money: emergencies, large purchases, retirement, and children. And there are many reasons for spending it: needs, conveniences, pleasures, and expenditures which retain value, such as a home and education. You will have to decide for yourself, either according to a planned budget or on the spur of each moment, what you will spend for things you consume and what you will borrow or save. In the next program, you'll learn about budgets and how to evaluate your assets and liabilities. Some of the things we buy have lasting value, and those which have lasting and immediately saleable value, like a home, are assets. Here are some typical assets. If you plan ahead, what is the plan called? Liabilities are amounts you owe. These are some of the usual liabilities. What are some other liabilities? Yes. A list of your assets and liabilities is called a balance sheet. The list doesn't actually balance until you add another item called your net worth, which is just the difference between what you own and what you owe. Joe and June Brown have $500 in cash and deposits, $3,000 in personal property, a $5,000 car, and a $50,000 home. They owe $400 in bills, $4,000 on the car, and $40,000 on the home. How much are their total liabilities? Yes. If the Browns have $58,500 in assets and $44,400 in liabilities, the difference is $14,100. What do we call this difference? Today, your money may not be the most important factor in your life, but at times in the future, money problems will seem critical. You'll find it important to learn how to spend and save your money, and the following programs will help you learn.